Let's take a look at the markets with major averages hovering near all-time high. Joining us now is Katie Stockton, Fairlead Strategies founder and managing partner, as well as a CNBC contributor. Is there fatigue? Is the rally hated? Is there more left? Are valuations too high? In your view, what?
Maybe all of the above. It is a very persistent uptrend, and we saw a breakout in June to new highs, and there really is nothing bearish about new highs. So there's not a lot not to like about it from a technical perspective. We are skeptical, like everyone else, I think, about its sustainability, and yet the breakout did foster additional upside momentum. It allowed for a price objective of about 68.80 with a time frame of 2026, and left support in its wake right around 61.30, which was former resistance.
I'm down on charts and technical analysis. I think the last couple of moves you've been looking for new lows, and they never came. And you,
in June, we were bearish, looking for retracement.
Both, and the time before that, too. So staying bearish. It didn't tell you. Your charts and your technical analysis didn't tell you what was good. They were useless.
The hard part with this is that you see snapshots, right? We write about the markets every day.
Right.
And we were very constructive at the April low and moved to a bearish short-term bias in June. So we have been tracking the indicators very closely. Of course, we can't predict anything, but we do our best to try to keep probabilities on our side.
51% is probably good. So how about oil? I mean, that's 62 today. What's that indicating?
It's low 60s. I believe that there's a major low in place. We saw an oversold indication on the monthly chart around the April-May lows in crude oil, and yet we need to see some kind of breakout above resistance to suggest that that downtrend is reversing. The resistance is in the mid-70s, so I think it's got some work to do. And meanwhile, energy just continues to underperform as a sector.
Yeah. With Jackson Hole and with the employment report we got, and then the CPI, PPI, I think the yield curve is more important than ever, probably. But nothing's happened, really. We're even at the low end of the range, aren't we? Sort of with 429.
It's interesting. Yeah.
Remember, we were happy because we had three major levels for the 2-year, the 5-year, and maybe it was the 30-year. But I think we had 4.5 was the one for the 10-year. Got to watch 4.5, and then we had one for, I think, the 2-year, what was it, 4% if it gets above that? And we're well below on the entire...
We've had a neutral bias on yields for pretty much all year.
There
and
you
I think
go. It's like watching paint dry.
It is.
Like watching grass dry.
It's still appropriate. This morning I was looking at the Fed funds rate relative to the S&P 500. I thought that was an interesting comparison. You look at peaks in the Fed funds rate, and when it peaks, it tends to be associated with peaks in the S&P 500. So it is interesting, and you do feel like people are looking for rate cuts, and they welcome them. And yet the charts would suggest that that's not necessarily something that we should wish for.
I wish you could do support and resistance for earnings expectations, because we were at 5% and we did 12 again, even with tariffs for this month. And now we got retailers obviously coming in, but it was a very solid.
And that's why the market has a good bid to it, I think, because the breadth actually hasn't been terrible. It's not been great, but it's not been wholly related to the mega caps. Obviously, they're still giant contributors to the gains this year. But the breadth has been decent. I think earnings did serve as generally a positive catalyst. We saw more gaps up. We saw more short-term breakouts, certainly, than breakdowns. With the removal of that, then there's a bit more of a proof point. We do also have some seasonal headwinds at this time. August, September carry volatility. That's not how we invest, but it does inform sort of our biases. What we've defaulted to is the 20-day moving average. It's always been a favorite sort of short-term tool for us to track the trends. And with especially the S&P 500 and the NASDAQ 100, that 20-day moving average is still very much pointing higher. So our advice to our research clients has been to stay with it as long as that's the case. And when it rolls over, it's enough of a loss of momentum to suggest that you can reduce exposure.
I mean, we almost always have a selling climax in October, which means August and September. It's almost like night follows day. Shouldn't we think that's coming?
Yeah, when I look at the VIX, it does seem like it should go higher from here.
Right.
It has an oversold indication from the DeMark indicators in the same way that the S&P has a countering indication. But Again, we're not repositioning with that in mind. We're sort of waiting to see the momentum shift, and then we will react to it accordingly.
It's like hurricane season. Is it going to be a bad hurricane season or not?
Yeah. And so October does tend to carry volatility as well, but also carries major lows.
Right.
So wouldn't that be great to see that kind of volatility come in the next few weeks and allow for a nice push higher and sort of a reset button for the Q4 season?
I mean, even if you see a massive pullback, you're still talking potentially about the S&P trading above 6,000. Because we're at, what,
right.
6450?
6130 is initial support. Secondary is around 5,500. If we were to see upside follow through, the objective being around 6880, that's a 6-7% above. It's not super dramatic in terms of upside potential, but it does lend a bullish long-term bias.
Just for people who have been waiting for that opportunity to buy, you're going to need a bigger and bigger pullback to make
that's the hard part.
Sense.
And that's why you just have to be willing to buy into strength and keep those moving averages on your side.
Looked like Bitcoin was off to the races, but I don't know, the PPI. I heard maybe that the Treasury Secretary said some things. Some people said it was positive. Others said it was negative about whether the government buys Bitcoin. But when you have a hot PPI number, that gives the Fed pause, and then you don't get the rate cuts. And it just risk off, too. So
yeah.
Where's the support for Bitcoin?
They're more range bound.
Bitcoin's 115. The support's 60,000 in your view, and the
60,
yeah, 60, and the upsides 400,000.
There you go.
So we expect a range between 60 and where is the support?
And we've talked about this before, where Bitcoin has this propensity to stair step higher. Right now, it's on a stair, so very much a neutral short-term bias after having broken out above that former resistance to new highs. Yeah. That former resistance was just above 108,000. There's additional support around 111,000. So it has good support for this consolidation phase. And that breakout, if you recall, allowed for an objective of about 134 to 135.
Yeah. Plenty of people that still think the support, near-term support is zero.
There are some.
Yeah, there are plenty.
There are some.
All right.